The Auditor-General provides assurance to Parliament on the accountability and performance of the Victorian public sector. The Auditor-General conducts financial audits and performance audits and reports on the results of these audits to Parliament. On 26 November 2013, the Auditor-General tabled his report on the Annual Financial Report of the State of Victoria, the AFR. The AFR was provided to Parliament on 14 October 2013. The Financial Management Act 1994 requires the Treasurer to prepare an annual financial report each year. The Audit Act 1994 requires the Auditor-General to provide an audit opinion on the AFR and prepare a report to Parliament. The Auditor-General's report makes comment on the results of the financial audit of the AFR, the financial performance and position of the State of Victoria for the year ended 30 June 2013, and key capital projects that are underway. The AFR consolidates the financial information of 289 state entities to provide a set of financial statements for the State of Victoria. The Department of Treasury and Finance prepare the AFR for the Treasurer and conduct the consolidation exercise. A clear audit opinion was issued on 27 September 2013, thereby providing reasonable assurance that the AFR is reliable, accurate, and prepared in accordance with the requirements of the Financial Management Act 1994 and Australian Accounting Standards and Interpretations. The Department of Treasury and Finance, as preparers of the AFR, are to be commended on the improvements made to the accuracy of the preparation process in 2012-13. In particular, DTF addressed lessons learnt in the prior financial year, systems issues and deficiencies reported in 2011-12, and long-standing cash flow statement issues. To facilitate and focus the preparation of the AFR, 49 entities were deemed to be material for 2012-13. By material, we mean that the financial reports of these 49 entities collectively make up over 90% of the transactions and balances in the AFR. DTF set a timetable for material entities to submit information which is earlier than the reporting timeframes required by legislation. This is so that the AFR can be prepared in a timely manner. The first draft of the AFR was provided for audit on 29 August 2013, consistent with agreed timeframes. In 2011-12, the previous financial year, DTF set a more realistic timetable for material entities to finalise their financial reports. Notwithstanding this, in 2012-13, only 16%, 8 out of 49, of the material entities achieved the financial report finalisation target date set by DTF compared to 40% last year. The late finalisation of financial reports by material entities puts at risk the ability of DTF to produce the AFR and have it audited within the statutory timeframe. In the Comprehensive Operating Statement, there are two key measures of financial performance and sustainability. Net results from transactions, revenue less expenditure that can be directly attributed to government policy, and net result from transactions and other economic flows, which represent changes in the value of assets and liabilities resulting from remeasurements. Both of these measures are calculated and reported for the general government sector and whole of state. The general government sector is a subset of the whole of state and is made up of 204 entities whose primary purpose is to provide public services. The state reported a deficit net result from transactions of $2.5 billion in 2012-13, compared to a $1.2 billion deficit in 2011-12. The state has now reported 3 consecutive years of deficits at this level. The deficit for 2012-13 was primarily driven by increased finance costs of $409 million associated with increased borrowings, most significant relating to 3 commissioned public-private partnerships, and increased employee costs of $737.7 million. For the general government sector, the government has set a key fiscal target to achieve at least a $100 million surplus on transactions. This was achieved in 2012-13, with a $316.4 million surplus reported. This surplus was supported by $1.2 billion in dividends revenue received from state agencies outside the general government sector. The payment of dividends is based on government policy, and the expected amount to be received is included in the state budget annually. The level of dividends received by the general government sector in 2012-13 is an increase of 75.5% on those received in 2011-12. This is principally due to $413.8 million paid or payable from the State Electricity Commission. A further $238.3 million was paid or payable by the 4 metropolitan water entities. These water entities borrowed to facilitate the payment of dividends and for infrastructure in 2011-12. City West Water and Melbourne Water did not have the capacity at 30 June 2012 to cover annual debt repayments from their operating profits. While the dividends paid to the general government sector support the achievement of the government's fiscal target, it does so at the expense of the whole of state balance sheet, upon which debt levels are increasing. The state reported a net surplus of $9.5 billion in 2012-13, compared to a deficit of $16 billion in 2011-12. The net surplus reflects positive movements in financial assets and liabilities, and a decrease in the value of the state's unfunded superannuation and insurance claims liabilities. Also included in the net result were asset write-downs of $163.5 million, $114.4 million Places Victoria, and $49.1 million Education Sector, which represent future revenue or benefits that the state will no longer receive. Over the 2012-13 financial year, the state's borrowings increased by $6.8 billion. At the same time, gross state product increased by a smaller percentage. This means that the state has a reduced capacity to service borrowings. The increase in borrowings was largely driven by recognition of 3 public-private partnerships, known as PPPs, in 2012-13. There will be a further $1.377 billion recognised as borrowings when PPPs currently being constructed are complete. The increase in borrowings is driving an increase in interest costs, which impacts the net result from transactions. When the state is committed to spending more money on interest, it has less money to respond to revenue changes and unforeseen expenditure. This report comments on the financial implications of significant capital projects being built during 2012-13. The report has these separated into 2 chapters: significant projects and developments, and public-private partnerships. Most major asset projects commented on in the report are progressing well against budgets and timeframes. Recent developments. In December 2012, in the Securing Victoria's Economy document, the government signalled its intention to cease disclosing budgets for major projects due to commercial sensitivities and the potential to inflate tender prices. In line with this stated intention, the costs for 6 projects were not disclosed in 2013-14 state budget. The government did not indicate at the time of the announcement, or subsequently, whether or at what stage project costs would be disclosed. The lack of project cost information limits the ability of Parliament and the public to hold the government to account for the efficient and economic delivery of major projects, or to understand the scale of projects and cost of public monies allocated. We recommend that DTF should determine and inform Parliament and the public about when expected costs for each major project will be made available. We have made comment on the Regional Rail Link budget in previous Auditor-General reports on the AFR. In November 2011, we reported that the budget for Regional Rail Link, RRL, was under review when a revised budget had already been approved. None of the Regional Rail Link Authority, Department of Treasury and Finance, nor the Department of Transport at the time informed us of the new budget and corrected the inaccuracy when drafts of our reports were provided for fact-checking and comment. As a result, what we reported to Parliament was inaccurate. It was not until October 2012 we were notified, and in November 2012 provided evidence of the revised budget decision. Correct budget information was reported in 2012. The lack of disclosure of information to audit is a significant concern. The move away from disclosing cost information in the budget for significant state projects now makes it even more important that disclosures and all project information is available to the Auditor-General. This report makes comment on the following key state projects: the Box Hill Hospital redevelopment, the Goulburn-Murray Water Connections Project, the M80 upgrade, Mikey, the Port Capacity Project, Regional Rail Link, and the Western Highway upgrade. In addition, the report comments on 3 public-private partnerships referred to as PPPs. PPPs are when the private sector builds, finances, owns and operates public infrastructure for a period of time in exchange for regular service payments from the government. At the end of the contract operating period, the assets revert to state ownership. The PPPs commented on in the report include the Bendigo Hospital, Victorian Comprehensive Cancer Centre, and the Wonthaggi Desalination Plant. The desalination plant is the biggest PPP in place in Victoria currently. It was completed and moved into its operating phase on 17th of December 2012, approximately 11 months after initially scheduled. The total nominal cost of the desalination plant is $18.632 billion, which is $993 million higher than what we've reported last year. This increase in cost is because the state recognised the minimum contractual commitments in relation to renewable energy certificates and connection services charges that had not previously been recognised. These formed part of the project deed and were identified by the Department of Environment and Primary Industries after a complete contract review in December 2012. Also, the electricity costs associated with the plant were previously estimated and are now final. The state committed to offset 100% of the carbon-based electricity required to operate the desalination plant with renewable energy through the purchase of renewable energy certificates, RECs. The project deed requires the consortium to purchase a minimum of 451,000 RECs annually. Approximately 36,000 RECs will be consumed annually by the plant while it remains idle. Surplus RECs at the end of the project term are an asset of the state. We estimate that approximately 11 million RECs will be due for transfer to the state at the end of the operating period if zero water is purchased. No water has been purchased to date. A zero water order has been placed for 2013-14. The report makes one recommendation: that the Department of Treasury and Finance should determine and inform Parliament and the public about when expected costs for each major project will be made available. All our reports are available on our website. If you have any questions about this or other reports, or if you have anything else you would like to discuss with us, including ideas for future audit topics, please call us on 03 8601 7000 or contact us via our website.